Hi, everyone. Thank you for joining us for today's webcast, Pandemic Playbook with Economist David Rosenberg, sponsored by Spraw Asset Management. Today's webcast will be providing one CFP, one CIMA, and one CFA CE credits. If you have any questions on credit, please don't hesitate to give us a call at 704-540-2657. We welcome any questions you may have at any point in time during today's webcast. You can type your questions in the Q&A box to the right of the slides, and we'll do our best to get to as many of your questions as possible. In the event your question is not answered on today's webcast, a member of the Spraw Asset Management team will get back to you directly. We have made materials available for you to download in the Documents folder at the bottom of your screen. As always, we appreciate your feedback and are striving to make these events the best they can be for your viewing satisfaction. At your convenience, please take a moment to take our survey that is also located at the bottom of your console. We will cover quite a bit of information during today's webcast. If at any point in time you are interested in scheduling a one-on-one meeting with Spraw Asset Management, please click the one-on-one folder at the bottom of your screen and confirm the request. In the event you missed any part of today's webcast or simply would like to watch it again, a replay will be made available and all registrants will receive that information by email. So with that, I'd like to turn it over to today's first speaker, Ed Coyne, Senior Managing Director of Global Sales for Spraw Asset Management. Ed?
Thank you, Natalie, and welcome all to today's webcast. My name is Ed Coyne, Senior Managing Director and Head of Global Sales at Spraw Inc. With me today is David Rosenberg and John Hathaway. David Rosenberg is the President and Chief Economist and Strategist of Rosenberg Research and Associates, which is an independent financial markets and economic consulting firm launched in January of 2020. David's company is uniquely positioned to provide clients with unbiased insights and actionable investment guidance. David provides traditional daily commentaries, but also includes in-depth reports, podcasts, and timely data, technical analysis, conference calls, meetings, and customized services. David has provided economic and market strategists for more than 30 years, both on the sell side and the buy side of the business, on both Bay Street in Toronto and Wall Street in New York. David was a chief economist and strategist at Gluskin Sheff, a Toronto-based wealth management firm, and prior to that, he was the chief North American economist at Bank of America and Merrill Lynch from 2002 to 2009. David is also the author of Breakfast with Dave, a daily economic and financial markets insight and forecast report he has published under various names and titles since 1998. In addition to David, we asked John Hathaway, our very own Senior Portfolio Manager, to also join us. John is the CFA and Senior Portfolio Manager at Spraw Asset Management. John joined Spraw in January of this year and is the Portfolio Manager of the Spraw Hathaway Special Situation Strategy and the Co-Portfolio Manager of Spraw Gold Equity Fund. Previously, John was at Tocqueville Asset Management, where he was the Co-Portfolio Manager of the Tocqueville Gold Fund, as well as other investment vehicles in Tocqueville Gold Equity Strategy. Prior to Tocqueville, John was a co-founder and a manager of Hudson Capital Advisors, followed by 7 years with Oak Hall Advisors and Chief Investment Officer. John earned his BA from Harvard College and his MBA from University of Virginia. So with that, I'd like to give you a brief commercial on who Spraw is for those that aren't that familiar with us. Spraw is a very unique firm in regards to what we focus on. Spraw is a publicly listed company on the Toronto Stock Exchange with the ticker symbol SII, and will soon to be also on the New York Stock Exchange by late June. Spraw is one of the largest precious metals firms focused on purely precious metals with over $12 billion in assets under management. What's unique about our firm is that we offer 3 unique avenues of solutions in the gold and gold equity space. With over $8 billion in physical metal made up of both gold and silver, pure gold, pure silver, as well as platinum, palladium, Spraw is one of the leaders in the unique physical trust environment. In addition, we offer a suite of equity portfolios with over $2.3 billion made possible with the recent acquisition of the Tocqueville Gold Fund back in January of this year, along with John Hathaway and Doug Groh and his entire team. In addition to both the physical and the equity, we also have unique debt solutions where we actually finance and lend capital to predominantly junior mining companies with close to $1 billion in current capital outstanding. We call institutional clients, pensions, foundations, and sovereign wealth funds among many of our largest clients. And with that, I'd like to now turn it over to David Rosenberg, Chief Economist, to talk about what's going on in today's market and a view into the pandemic playbook. David?
Right. Well, thanks, Ed, and good afternoon, everyone. First and foremost, I just want to wish everybody good health and that you're all safe and well. The theme is really the Great Repression, and the tagline is business will not be as usual. And a 3-month rally that I'm sure historians will look back on as basically a blip on a screen, hasn't altered the big picture perspective. And for the historians out there, I want to remind everybody that we had no fewer than 6 absolutely monster rallies in the 1930s, 2 of them bigger than the one we just experienced. So just as every bull market has its pullbacks, every bear market has its bear market rallies. So please don't confuse this period of liquidity and rampant speculation for the real thing. All that said, I remain of the view that the level of conviction I have in anybody's forecast on the economy or the markets right now, and I'd include my own, is several standard deviations below the norm. And I actually feel that I'm in pretty good company when you consider that more than a third of the companies who reported their quarterly financial results so far have pulled their full-year guidance, which is something we haven't seen happen since the collapse of Lehman in 2008. As it stands, a bit of a recap, the second quarter hole in real GDP is getting bigger and bigger, with all deference to Friday's employment report, and it's getting bigger and bigger in every country in the world. Looking at what is being built in on the data, and remember, what goes into GDP is spending, not employment. And when you're looking at real GDP, it looks to me as though we could be down in the U.S. at least 50%, 5-0, for the second quarter at an annual rate. And remember that this follows a 5% GDP decline in the first quarter. So for everyone who's saying, oh, that they just can't wait to get back to the pre-pandemic economy, be careful what you wish for, because the NBER just told us yesterday that the recession actually started in February, not in April. So the decay actually was already in play. And like I said, the hole we have to dig out from is just getting bigger, and the economic math is daunting because to recoup a 50% plunge in GDP means it has to then surge 100% just to make up for the deep loss. At the same time, I think we also have to consider all these government programs are only bridge income replacement support mechanisms. That's all they are to fix a leaky boat. Keep in mind, this is not FDR New Deal stimulus. When we built the Golden Gate Bridge, the Hoover Dam, the Triborough Bridge, the Lincoln Tunnel, Route 66, this is not fiscal stimulus with any future multiplier impact or productivity payback. It is simply government-assisted life support. And so meanwhile, watching the stock market today, for me, it's been like watching a clown blowing up a balloon, knowing the inevitable, although I have to say that it is impressive to see the level of confidence that the bulls have at the moment. All I can say is that either the investment community sees the Fed going beyond high-yield corporate bonds, actually coming in and buying stocks at some point, or investors view that all we've seen here is just purely temporary, that the economy is going to miraculously bottom with all the reopenings, and that even if things don't get back to normal completely, they'll get back to normal just enough to warrant the sky-high multiples being where they are right now. So look, it's hard to handicap just how far the Powell Fed is going to go, that much I'll admit. I used to actually talk about them going into the junk bond market and bailing out the fallen angels, but in truth I was just saying it in jest. I won't for a second assume that the Fed doesn't have the stock market on its mind at all times, and Powell has proven to have been as much a backstopper and market manipulator as Greenspan and Bernanke. And I'll be the first to acknowledge that fighting the Fed, admittedly, is a futile game. Be that as it may, what central banks everywhere have done is to make it next to impossible to appropriately price risk, and they've created tremendous moral hazard by bailing out poor managers of risk. But the academics will tell you that this is what it takes to save the system. Another financial sector bailout. The last one was for the banks, and this one is about credit hedge funds. Now, in terms of predicting when things turn to normal, assuming they ever do, The problem is that we don't have a template, we don't have a playbook for this type of exogenous shock that was a simultaneous demand and supply shock on a global scale. So, it'd be one thing if this was 2008, 2009, when all it took was a ring fencing around and then a recapitalization of the banking system to put in the lows in March of 2009. It'd be one thing if this was just about mopping up the excess capacity in the tech sector, which finally helped establish the lows in the fall of 2002. Or it'd be one thing if all we had to do was just wait for RTC to absorb the commercial real estate mess created by the savings and loan crisis back in 1990 and 91, or maybe just if we could wait for Paul Volcker to finally slay the inflation dragon in late summer of 1982. But this current situation is all about when and if a treatment or a vaccine come to the fore. And that could take months, it could take quarters, it could even take years. It is definitely not about the reopening of the economy, because what's going to matter most is demand. There is no renewed hiring cycle. There is no sustainable production growth that brings the unemployment rate back down in any meaningful way without demand. Demand is the key. But I can tell you that the stock market's behaving in a way that it almost seems to be expecting a vaccine to have successfully completed all of its trial phases and be proven to have been safe and effective. And I'm talking about by this fall. And I say that because of the sort of value and cyclical stocks that have taken leadership very recently, and now the market is completely ignoring these heightened tensions between the U.S. and China, what's happening in Hong Kong, let alone the riots and demonstrations, which obviously go beyond just police brutality, but also speak to the extremes of income and wealth disparities. But I can tell you, by the way, that will emerge as the number one economic and political issue heading into the November elections. Things that a year ago would have been sending the stock market into a tailspin are now being ignored, because if it's not about the Fed at any given moment of time, then it's all about an upcoming vaccine treatment around the corner. I also think there's a lot of excitement in the marketplace around these reopenings happening around the world in all 50 states. And while the economic numbers, the high-frequency weekly and daily trackings, they're all showing less negative readings, the bottom line here, folks, is that the economy is still struggling. It isn't just about reopening the economy, because what social distancing does is it impairs capacity in practically every industry, including the consumer cyclical service sectors that have been rallying the most lately. But what's going to matter most, again, is what demand does. The daily mobility trackers, well, they look very exciting to the bulls. All the pictures in the media show lineups. But the reality is that when you go to the polls, you'll see that most households, in fact, the vast majority of them, are already saying that they have no willingness at all to go to a restaurant, even if they're opening up. And the reality is that restaurants with 25 to 50% capacity are going to go bust even after they rationalize on their space expenses. I mentioned before, there was a Coyne survey I saw over the weekend, 2,500 households in May, found that 3/4 of them plan to dine less frequently as they did before, or they're going to just avoid restaurants altogether. I'm looking at the data from OpenTable. Yes, they've improved. The reservations are still 80% below where they were a year ago. I look at the hotel industry. Yes, occupancy rates 32%, up from the recent lows of 21%, but a normal level pre-COVID is 62%. I also found a Chicago Fed study that was just done in the past month. It found that 3/4 of firms say that the U.S. economy is going to need at least a year to fully recover from the pandemic. I don't think that's priced into the stock market right now. There were 670 respondents to the poll. Half of them told the Chicago Fed that the recovery will take between 1 and 2 years to develop. And then the other half was split between recovery in less than a year and one that takes more than 2 years. And here is the conclusion of the report. It said in quotes, many of the small businesses we heard from, especially those in the entertainment, tourism, recreation, restaurant, and retail sectors, are in danger of financial distress. Many businesses are facing very difficult challenges that are unlikely to go away quickly, end of quote. Now look, you tally up these sectors. They support 32 million jobs, or about a third of the private sector workforce, and it looks to me as though half of them aren't going to be getting their old jobs back. And I'm not sure many people understand that amusement parks, airlines, restaurants, hoteliers cannot stay in business at 50% capacity. I think people have to understand that for these sectors, like restaurants, they spend 30% on labor, 30% on rent, and 30% on food. They have 10% margin, so good luck with the partial reopening, with the social distancing. And so all these polls basically say the same thing. It's not going to be business as usual as the bulls try and convince you. And I think the best we can hope for is a partial recovery. I mean, at best. We have in our hands vertical down economic decline with job losses an order of magnitude higher than anything we've witnessed since the Great Depression. So even if the stock market is telling you, that it has it all figured out, I can assure you that what we face at this very moment is a highly uncertain economic future, and unfortunately, most of the longer-term economic risks are to the downside, not the upside. I'll repeat, we are in a depression. Not a recession, a depression. And I didn't say the Great Depression. It's a depression. And I think the dynamics of a depression are different than they are in a recession because depressions invoke a secular change in behavior. Classic business cycle recessions are forgotten basically within a year after they end. At a minimum, depressions entail a prolonged period of weak economic growth, widespread excess capacity, deflationary pressure, at least initially, and a wave of bankruptcies. Asset markets, as I see them, don't reflect the economic depression. They only reflect now a V-shaped recovery, which I can tell you is nothing more than pure fantasy. I think the best outcome is something that's L-shaped or maybe backward J-shaped recovery, and repeat, that's the best case. That's what I call a slow, jobless recovery made possible by continued and constant support from gaping fiscal deficits and central bank liquidity. Now, with that in mind, I want to bring your attention to another report by the San Francisco Fed, which does the best research, by the way, from the Fed, a report they published in March, well worth a look. You can pull it down. It's called Longer Run Economic Consequences of Pandemics. In a nutshell, they studied the medium to long-term effects of major pandemics, 15 in total dating back to the 14th century, and the major finding was a secular shift towards greater precautionary savings. At the same time, investment demand also tends to decline, and the impact of these great historical pandemics of the last millennium has been to exert lasting downward impact on something very important, which is the natural and neutral rate of interest. In fact, the natural rate of interest goes down on average 150 basis points once the pandemic hits in the decades that follow, which is maybe one reason why we can't rule out negative interest rates, which, by the way, is currently officially being discussed in the UK, and especially when you consider that the starting point this cycle on the neutral rate was a fraction of 1%. Let me just read you the conclusion of that San Fran Fed report, if you'll allow me. Quote, following a pandemic, the natural rate of interest declines for decades thereafter, reaching its nadir about 20 years later. At about 4 decades later, the natural rate returns to the level it would be expected to have had the pandemic not taken place. History shows that real neutral rates can be depressed for 5 to 10 years. End of quote. Now, if that's not an advertisement for physical gold, I don't know what is. And then we have to consider, when we get to the other side, the massive government debt we've built up and how that, along with these bloated central bank balance sheets, how they're going to get dealt with. Will these debts get monetized or not? And again, it's interesting to see the Bank of England openly heading in that direction. Will tax policy have to change as it did to defray the cost of fighting the Great Depression? So what the world looks like when the crisis ends is truly anyone's guess. I would say with 100% clarity it's going to look a lot different than it did before. Not just the question over government policy, but at the individual level, months of isolation and distancing, the fear of a return of the pandemic, and now we're seeing the case count rising in at least 12 states that have reopened. They are going to fundamentally alter lifestyles for the future. There will be a profound influence not just on the way that we live, but how we conduct ourselves in our personal and our commercial lives. For example, working from home, which I'm doing now, is certainly going to be a much more dominant force. Obvious negative implications for commercial real estate, but positive implications for internet infrastructure, computer hardware, video conferencing. There's going to be a sharp reduction in travel to work, travel in general. That tells me fewer cars on the road. Nothing here that's good for the auto sector, not just office REITs. But there's going to be some bullish themes that will emerge, that are emerging, as we go into an era of elevated personal savings rates where people are going to focus on what they need, not what they want. So it was very interesting to me, behaviorally speaking, to see what consumers were spending their money on in the past few months of lockdown besides just canned food, toilet paper, and booze. Things like garden supplies, bread makers, jigsaw puzzles, anything related to e-commerce, cloud services, or wiring up your home to become your new office. So delivery services, well, they've now become an essential. So here is a budding bull market right there for any business model that copies Amazon or Amazon itself. I should tack on grocery chains with online services coming out of this as a winner. So the shifting behavior that has already taken place tells me to focus on consumer staples and other areas of the market, healthcare, even big tech, that have become essentials. Microsoft, it could be argued, has become a utility. One could argue that Amazon's become a utility. One could also argue that Google may have become a utility, and it's apparent to me that you want to have exposure to healthcare because this clearly is an underinvested area and will, without a shadow of a doubt, become less regulated in the future. And then there's other ways to hedge and diversify, such as REITs, which have stable income. I'm particularly referencing multifamily REITs and industrial REITs benefiting from the Amazon effect. I think sustained low interest rates make their stable yield more attractive. The cap rates will remain lower for longer. So look, I might not be bullish on the entire market, but you can certainly create your own index that fits the theme I'm describing, which brings me to one of my key investment ideas for the current state of the world. Gold is a very good hedge against the instability that the extremes of deflation and inflation bring. If there's deflation, interest rates will remain low or go negative, making the opportunity cost of holding gold nil. If there's inflation, gold will do well as the traditional store of value. Lastly, all this central bank alchemy has led to ever increasingly unstable markets, and gold will continue to grind higher against this backdrop. So I think a strong case can be made if you have, say, a 3 to 5 year view that stagflation is going to emerge as a new secular theme coming out of this crisis once demand stabilizes. So think of a future with massive public deficits, massive public debts, government intervention in the economy and regulation, and a world of reduced globalization, more localized supply chains, and what the future holds for taxation. So my belief is that globalization slows or stalls here. I think the cost-saving strategy of just-in-time inventories does the same because we've seen in real time the importance of having important stockpiles on hand. And the implications of everything I just mentioned means that for every unit of production, the global corporate cost curve goes up in a secular fashion. And since for a while we'll still be operating with a deflationary output gap, this in turn means more compressed profit margins. This at a time when share buybacks are going to be slowing in favor of retention of cash on business balance sheets. So yes, Fed liquidity will continue to prop up the markets near term, but the fundamental picture I see is very weak outside of the specific investable themes that I put in front of you. And as I said, the laundry list of outcomes all comes at the cost of a higher corporate cost structure, compressed margins, which again leaves me wondering why so many people who focus on normalized earnings think that there's no impairment to the future earnings curve. Not to mention, by the way, how China's relations with the rest of the world are going to undergo a major transformation, and not just China, but I think we can reasonably expect a rising tide of nationalism, populism, isolationism to gain more momentum globally. So from a real big picture perspective, we come out of this with a world that's going to be smaller, a world that's more nationalistic, more protectionist than before. That was a trend that we already saw was in motion from the trade conflicts that started about a year and a half ago. And there'll be more regulation, more government intervention, and more global supply chains becoming localized. And I should probably add socialism to the mix. Knowing what history has to say on what happens when the economy enters a crisis with unprecedented income and wealth disparities, as I'd mentioned earlier. Let me just say that in these riots and these demonstrations that we've been seeing, many, not most but many initially, came from outside these cities and were not local civil rights groups. These were far left groups, meaning that these groups were using George Floyd's death to protest and attack on their far left agenda. And I'd say, for the record, aided and abetted by the Fed, the wealth gap just keeps getting bigger and bigger. So here we have the makings of a backlash, and I think we probably will see, and we may well see ahead and after the November elections, an Occupy Wall Street on steroids. You know, everyone is comparing this current situation to 1968, and maybe that isn't a bad thing to do, except for the fact that the music was a lot better back then. And when you go back to learn from history, and you go back to 1968, you'll see that we were at a real inflection point from a financial, political, economic, and social perspective. From a risk standpoint, it marked the end of a 14-year bull market and the onset of a 14-year secular bear market, and the latter coinciding with escalating geopolitical tensions, beggar-thy-neighbor currency policies, Fed-induced inflationary strategies, massive fiscal deficits, regulation, heavy government intervention in the economy, accelerated labor power, which impinged on profit margins for years to come. In other words, and I'm going past the next year or two, this is basically maybe talking about dessert as we're still setting the plates for the appetizer, but I would say that stagflation, the bitter enemy of financial assets, but the friend to real tangible assets like precious metals, and I'd throw real estate into the mix too, maybe not office or retail, but residential and industrial for sure. So at the risk of sounding like an Economics 101 professor, and this is my last thought, what I'm describing here is a future, maybe just a case of looking at the forest past the trees, which I never find the stock market is very adept at. And what I see in the future is a sclerotic or inelastic aggregate supply curve that is going to ensure a future of cost-push inflation, even with lingering weakness in aggregate demand. That might be 2 or 3 years away, but something worth putting a reminder on. That's what stagflation is. Higher inflation, even with weak economic growth. So I think at some point, we'll be dusting off the 1970s investment playbook. Either way, gold comes out a winner. It is my highest conviction call right now. If for any other reason, then it is a currency that has no government's liability, and its production growth runs at a pretty reliable and constant 1% annual rate, whereas the production of money right now is running at 23% for M2 and 33% for M1. I kid you not. That has already taken out the 20% growth peaks in the 70s and 80s when we were watching Happy Days, playing Trivial Pursuit, and listening to disco music. Ed, that's it for me. Pass the baton back to you.
Thank you so much, David. And I would agree with you. I think the market agrees that gold is certainly one of the assets to be considering. You know, it's sitting at about 1720 right now, and the market is voting with that, even with the rally we've seen here in the market in the short term. You know, for many of you that want to get more information on David's charts, we took the liberty to include many of his charts and topics he talked about today at the back end of this presentation. So once the presentation is over, you'll have the ability to download it and look at those presentation decks. And I'll talk more about Rosenberg research at the end of the call as well on how you could be more interactive with David and his team going forward. So with that, you know, David has talked a lot about the economy, the market, gold's role in the market. And what I thought would be interesting now is to really have John Hathaway, our senior portfolio manager at Spraw Asset Management, talk about not just gold, but also gold equity and how you can think about that in your portfolio today, why we're excited about it, what it's looking like, and how to allocate to it today. So with that, I'd like to turn it over to John Hathaway now for his comments both on gold and the gold equity market. John?
Okay, Ed, thanks a lot, and thank you all for listening in today. As Ed said, I will focus on gold equities. David gave a very good gave us a very good foundation for why gold should do very well going forward. I would just like to add a few things from my perspective, and that is I'd like to, even though gold has been rising for the last couple of years, it is still really early in this next leg of the bull market. I would call your attention to the fact that the Fed balance sheet in 2011, when gold peaked out at 1900, was $3 trillion. Today it's roughly $7 trillion and moving possibly to $10 trillion by the end of the year. Gold has not scaled the previous peak of 1900. It's trading today around 1700. So just based on that one metric, gold could be trading substantially higher than it is, quite possibly as high as $3,000. Nobody believes that today, but I think that's a realistic consideration. The result of all this intervention by the Fed and by the federal government, and it's not just here, it's in Europe, it's also in China, is that we're going to be left with a level of debt all over the world that's much higher in relationship to GDP than any previous peak, substantially higher. And one thing we've learned about debt is that it is a dampener of economic growth. It also means that the likelihood of that debt being repaid is absolutely zilch. So what it means in terms of gold, and this is where I think it comes into portfolio construction. Typically, bonds have been the balancing mechanism for equity risk. And it seems very hard for me, especially in light of what David talked about as far as the likelihood of a kind of a stagflationary environment where there would be substantial upside in bonds. In fact, there could conceivably be tremendous risk in bonds. So what's left as a portfolio stabilizer? There aren't many options, but gold is one of them. Gold is uncorrelated with financial markets. It is a beneficiary of the money printing that's been taking place, and I would think that as this dawns, as bonds become less and less of a safe haven, which is historically how they've been viewed, investors will look around for an alternative. And that alternative, there'll be others, but gold is the big liquid portfolio risk mitigator that basically bonds are vacating that space. So what we have is a landscape that's very, very friendly for gold, and yet, and we see it at Spraw, we see some inflows, some pretty strong inflows into physical metals. But by and large, I would say it is still not a mainstream investment thought. So I would say it's way underrepresented in portfolios, and in fact, I think this is going to be the key driver of higher gold prices over the next several years. Let's just go to the next slide, and I think it's a reminder that gold has been a very good performing asset relative to equities and bonds for many years. It's kind of been in a stealth bull market. And as I said just before, gold has yet to break out to new highs, but based on the fundamentals, I think in the next couple of years, it's a pretty good bet that it will. The next slide basically is shows you that in the last couple of years, gold has outperformed mainstream equities. And again, this is without gold scaling to new highs. So, and even with that, I would say gold has not gained a big following. So the rest of what I want to talk about is the equities. And the principal thought is that if gold is going to go to new highs, gold mining equities are going to be a very dynamic way to position portfolio assets. typically in a bull run for the metal, the gold stocks outperform the metal by 2 to 3 times. That's just based on past history. The fundamentals of the gold miners are as strong as they have ever been. It's not hard to find companies generating up to 10% free cash flow yields. And that's, I would suggest that that's very unusual across the board in terms of other industrial sectors, other sectors of the stock market. So here we have an island of value, very, very cheap, and companies very, very healthy. We're seeing more and more dividend hikes and share buybacks. Again, this would be anomalous in the context of the rest of the market. Gold stocks have never been cheaper in the past many decades. And here we see on slide 11 that the ratio of gold stocks to the gold price is the lowest it's been in as I say, in decades. So I would say just to normalize that relationship, taking that almost 20 years of history, there's a substantial uptick just in terms of valuation, even without further rise in the gold price. Let's go to the next one. As I mentioned, the fundamentals are very positive. We're seeing company after company report strong earnings. Again, I would say from what I see, most sell-side analysts are not pricing in the full benefit of higher gold prices into their earnings models. So even though the gold stocks look relatively cheap on first sight, they're even cheaper than that because most sell-side analysts are not fully pricing in current gold prices and the possibility over the next 3 or 4 years that gold prices will rise still further. And here are just a few slides on gold stocks relative to other mainstream equities. We can see that on valuation, I've already mentioned this, that gold stocks are trading at a discount to a standard mix of S&P names, just in terms of price to EBITDA. They're healthy financially. The bottom panel on that slide shows how healthy they are relative to S&P. And then lastly, they're much more solvent with a very healthy debt to EBITDA ratio compared to the rest of the market. And then let me just say that just a last thought here is that mid and smaller cap stocks are even cheaper, so that the opportunity than large cap stocks. So small and mid cap stocks represent tremendous bargains, and that's how we have positioned our portfolios, skewing them to the mid and smaller cap names in the gold space. And then lastly, gold stocks have outperformed the FANG stocks, which would come as a surprise, I'm sure, to most people. Here we're just talking about the large cap names, which have done really well. And then just last thought here is that the gold universe of mining stocks is tiny. It's about 260 billion. And if you look at that compared to the FANG stocks, it's a fraction of that. And then, so it would only be a small shift of allocation by portfolio managers to gold mining stocks that could drive them substantially higher. So I would end on that note and then pass it along to Ed for further questions.
Thank you, John. So before we go into the Q&A session, there's 2 points I want to make with regards to our speakers today. As I mentioned earlier, David Rosenberg and Rosenberg Research was kind enough to join us today. And for those that like what he had to say or want to learn more about how to work directly with David, they have been kind enough to offer all of our listeners today a 1-month free trial. So if you go and you look at page 17 here, you'll see a link, and again, you'll be able to download the entire presentation. But you can simply use the link rosenbergresearch.com/clients/register and sign up for a 1-month free trial to see how you could work with David and his team and get a deeper dive into his research. In addition, if you have further questions or interest on how to work more directly with David and his team, you can reach directly out to Marcel Alls, and his email address is here as well. So I encourage you to do that. We use David personally for a lot of our research. We like working with him, and I think for many of you in the advisor and brokerage community, you may find it useful as well. So I encourage you to try a 1-month free trial of that. As we go further into the presentation, before we go into the Q&A session, I do want to touch on a few things that make Spraw very unique. As I mentioned at the beginning of the presentation, we are really a leader in the physical side of the market. When I say physical side, we actually have very unique closed-end trusts or vehicles that allow investors to physically own the metal directly in a very liquid, unencumbered, direct way. So for those that want to own a combination of both gold and silver, we offer the Spraw Physical Gold and Silver Trust with the ticker symbol CEF, trades on the New York Stock Exchange. For those that want to purely have an allocation to gold, like David Rosenberg suggested as a core allocation, PHYS would be a very direct and liquid way to get an allocation to the physical gold and actually own it yourself. For those that want to take advantage of the silver opportunities out there, PSLV is a great allocation and great vehicle to allocate to silver. And then last but not least, for those looking at the platinum and palladium market, which is a very interesting market in its own right, SPPP is another trust that we offer to give you direct exposure. We also have 3 equity sleeves or equity options out there for you. We have 2 factor-based ETFs, one in the large cap senior mining space, SGDM, which is our senior mining ETF, and then SGDJ, which is our junior mining ETF. And then on the active side, with John and his team, Doug Groh, we have the SGDLX, and we actually have 2 share classes. We have a share class that provides a 12B1 fee for the advisors looking for the 12B1 fee for them and their client. And then we have the institutional class with no 12B1 fee. So depending on how you currently allocate your capital and build your book, you have 2 options there. So we would love to work directly with you and your clients. We have our country, or the United States, broke up into 3 major territories. You can see Matt, Julia, and Sergio based on where all of our listeners are coming into today. I encourage you to reach out to them in the respective territories to learn more about how Spraw can be your alternative into the gold and precious metals space. So with that, I'd like to turn it over to Natalie for a few housekeeping items before we go into the Q&A session, which, by the way, we have 97 questions, which is maybe a record for all the webcasts I have done over the last couple of years at Spraw. We will get to many of those, but we'll also get to others in the coming days via email and direct phone calls. So I appreciate everyone's interest and support in this webcast today. So Natalie, I'll turn it back to you.
Great, and thank you all for such an informative presentation. As a reminder, a copy of today's presentation as well as additional material can be found in the Documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey, also located at the bottom of your screen. Our speakers will be taking advisor questions. Please type your question in the box to the right of the slides, and we'll get to as many of your questions as possible. In the event your question is not answered on today's webcast, a member of the Spraw Asset Management team will reach out to you directly. If you'd like to have a conversation to further discuss the ideas that were covered during today's event, please click the one-on-one folder at the bottom of your screen and confirm the request. So with that, I'll hand it back to Ed for our first question.
Thank you, Natalie. The first one I think is probably best served for David, and it really comes down to employment. And David, the question is, do you anticipate a further setback to the recovery as the major corporations release early retirees and others who take special separation packages going into July, August, and September? What might that look like?
Well, look, I think that there's a risk that we do fall off a fiscal cliff. I think primarily if these jobless benefits don't get extended again, and if the state and local governments don't get some relief in the next fiscal package, which is getting resistance by the Republicans in the Senate, we have to keep in mind, I think the biggest risk is actually the state and local governments who have been laying off. They still laid off people in that Friday payroll report. As other people went to work, they were still letting people go in the state and local government area. And so they're running a collective shortfall of something like $650 billion, and they're not permitted to run deficits. So I actually think that's the overriding risk. The next one is what I said before. The big risk outside of the fiscal cliff is that demand doesn't come back to any great extent with the reopening phase. And I said before, companies that can't operate at anything less than 75% capacity, they're going to be shut down. So look, of course there's ongoing health risks as we're already seeing by the reopening as early as we did. But I'd say that if you're looking for what the risks are at the end of the summer, those are the chief ones.
And thank you, David. And this one's also this is for both you and John. Part one is for you, David, and part two would be for John, which I think I know the answer to that already. But, you'd mentioned earlier about the L-shape versus V-shape. It seems like we've all experienced in the last couple months a pretty severe V-shape recovery. I know you touched on that a bit, but can you give us a little more sense behind why that's happening? And the question basically is just the recovery seems to be V-shape at this point and not L, with a big capital letters Y. So can you give a little more color on that?
Well, how am I supposed to give color on a question that's telling me that we have a V-shaped recovery when I just said in the second quarter GDP is going to be negative 50%?
Yeah.
How are we getting a V? The stock market's in a V. Sorry?
Right. I think you're right. The stock market versus the economy.
Firstly, just because the stock market's pricing in a V, the same stock market that didn't see the pandemic, when was the first U.S. case? It was in January. The market didn't peak till the middle of February. So the stock market's telling you what? It's breathing in fumes from the Fed, and it might be pricing in a V-shaped recovery. And I'll be the first to tell you, if we get a vaccine, we will get a huge V-shaped recovery, if that's what you believe. The market's pricing that in. But I said before, you can open up the supply side of the economy. You can bring the horse, to water. It doesn't mean he's going to drink. This is what's happening in China right now. They've reopened the economy. Demand hasn't come back. That's why if you look at the inflation numbers in China, they're going down because there's a supply-demand imbalance. That's the big risk. The big risk is that without a vaccine, people will be very slow to re-engage in the economy, even as businesses open back up, and then they'll be forced to close because they're going to be actually incurring a net loss as they're just left trying to fund their working capital. So here's the reality: no vaccine, no V. No vaccine, no V.
I like it. That may be the slogan of the year. John, this one would be a good one for you to address. Some of the well-known investors out there have publicly talked about this. We've seen it written in many white papers and so forth. And this is maybe a bit of a self-serving question on our side, but this came in from one of our listeners. They see this as the best macro environment for both gold and silver, as well as miners, that they have ever experienced in the last 2 or 3 decades. I know you touched on that a bit. Could you give us a little more color into that? Is it gold, silver? Is it the gold miners, silver miners? Given the landscape we have today, what type of macro environment should we expect, or what opportunities are you seeing as a longtime gold investor?
Well, for the macro environment, which we've discussed at length, gold fits in very well. With very low interest rates, with the possibility of inflation, stagflation over the next 3 to 5 years, one should have a reasonable allocation to precious metals. It's amazing to me that all these luminaries, such as Druckenmiller, Seth Klarman, just to name a few, Ray Dalio would be another, having talked about this and actually having acted on it, Paul Singer would be another one that comes to mind, that so few people have really acted on this investment idea. And I think it's partly because mainstream thinking and gold just don't mix. Somehow an allocation to gold, a reasonable allocation to gold, somehow is seen to undermine the investment thesis behind most mainstream investing. That's not necessarily the case, but I think that's one of the great barriers. But I would say we really don't know where we're headed. What we do know is we're in unprecedented times. We're going to end up with a lot more debt than we ever had. Bonds may not be a safe investment as they've been thought to have been, and something has to replace bonds. That would be an allocation to gold. And for anyone who agrees with that basic view and wants a more dynamic exposure, some portion of that gold allocation should be in gold mining stocks, which, as I mentioned earlier, outperform a given move in the gold price by 2 to 3 times. So, and then silver is gold on steroids. One could make a case that silver has been very depressed relative to gold. The ratio of silver to gold is the widest it's been in possibly in the last 30 or 40 years. Any closing of that, and silver's a monetary metal, the same as gold. So to the extent that gold gets a bid for the reasons we talked about, it's very hard to imagine that silver wouldn't also catch a bid and quite possibly outperform whatever move you want to hypothesize in gold by a substantial amount.
Thank you. That actually, you just knocked out about 6 questions. As I'm going through all the questions here, you hit a lot of them, which is good. One follow-up question on that was, within your gold allocation, I guess from a percentage term, how would you view your split between the physical versus the equity? And would that depend on the type of client, obviously, but how would you in general view that split? Would it be 50-50 or what would an allocation look like in your mind?
Well, let's remember that gold is a very safe asset. And I would say for investors that are very risk averse, most of that allocation should be to physical metal. On the other hand, for those who see the landscape that we've been talking about as an investment opportunity and want to maximize returns from it, I would weight the exposure towards mining stocks because they'll give you much more bang for the buck. And again, I think it just comes down to where each investor is coming from, whether they're risk tolerant or risk averse.
Perfect. Thank you. David, this is a good one for you. So the markets were at actually it's a direct question to you. The markets were at historic highs a few months ago and have recovered quite significantly from the downturn. Without the virus, it seems like none of your predictions would have been realized. Can you please comment on that? And I suppose they're just talking about, I guess, your comments over the last probably few quarters prior to the pandemic. If you can comment on where we sit with that right now.
Sure. Well, look, I think we have to go back to last year where we actually had recessions in many key components of GDP. We had a recession in capital spending. We had a recession in commercial construction. We had a recession in productivity, and we had a significant recession in profits. So, look, what we then needed to save 2019 was 3 Fed rate cuts. If you remember, at the end of 2018, we were supposed to see the Fed normalize interest rates and hike 3 times. No. Jay Powell cut rates 3 times. Then by October, he's re-expanding the Fed's balance sheet to paper over the problems in the repo market. And so the market got into positive return mode. Most of it took place in last year's fourth quarter, when once again all the central bank machinations were taking place. So frankly, I feel it was right on the fundamentals, probably not right on the liquidity story. But as far as this year is concerned, remember what the NBER told us yesterday. I mentioned this before. The recession started in February. It didn't start in April, didn't start in March. Started in February before the pandemic really hit. But the decay was so evident in industrial production, in real retail sales, in real capital spending orders. They had all turned negative on a 3-month basis heading into February. That's why the recession was dated in February. And I just want to make this other point. Again, looking at the big picture, we have gone from what used to be in the days of productivity-led growth. When I started in the business in the mid-'80s, we used to have a real economy that used the markets as a source by which to form capital, and we form that to a financial economy that manipulates to create fake wealth. And we have all these bubblehead stock promoters just love it. But, just imagine a system we have where stimulus checks are being used to open up commission-free stock accounts to trade. And then come and tell me if that creates durable wealth, productivity-fueled income growth, and sustainable value-added employment. Not so sure it does. So we have a huge disconnect here that we've had for a long time that became exposed in this pandemic. Because who thought that a health crisis would morph into an economic crisis? Of course, an economic crisis. Companies were forced to shut down for a period of time. But I don't remember anybody telling me in February or March that the Fed was going to have to go into the high-yield bond market. I don't remember anybody telling me a few months ago that the Fed was going to aggressively ease policy by a factor of tenfold what it did in the Great Recession of 08 and 09. And that's because we just went into the situation tremendously over-levered at every single level of society, government, households, and especially businesses. So the reality is that's right. Once again, we have a cycle of debt accumulation and asset inflation that gets exposed by an external shock. And next thing you know, we need even more gargantuan intrusion and involvement by the central bank to create this artificial illusion of an equity wealth effect. So I think that's the situation we have in our hands right now. It's what should I say? It's no country for old fundamentalists.
Right. Well, we're at the top of the hour, and I do want to close with maybe one more. We're actually at 112 questions, which is surprising. So we've got a bit of follow-up to do here. But I was going through some of the other questions, and one that might apply to many people on this call that are thinking about kind of how to allocate new capital. Maybe both you comment on the directional move in the dollar and interest rates lower for longer and what that means for the overall economy and bonds. And then lastly, the question is, what are appropriate replacements for bonds for, I guess, an investor looking for income? So those are the dollar, rates lower for longer, and what else could you do besides bonds if you're an investor today? Either one of you guys can take that last question, and we'll wrap it up after that.
Well, I think most of that's for David. So, David, why don't you take the dollar, the bond, rates lower for longer?
I don't know. I'm pretty well. I'm bearish on all currencies, all fiat currencies that are being printed by central banks that have become financing arms of governments. So the U.S. dollar just might range trade. It's really the only currency whose production is stable and is constant and certain is gold. So it's the only currency I like. So, I can't comment. I guess we can sit and talk about the euro against the dollar, the Canadian dollar against the U.S. dollar. There might be currencies the U.S. dollar does well against, but I think it's just going to be in a holding pattern because I'm bearish on all currencies because every country shares the same affliction. I'll just say that, and this is where maybe I'll differ from John in this sense. I do like bonds, and bonds like gold have that inverse correlation with equities, and it's a different form of diversification. And I like both. I've been talking in my reports about the bond bullion barbell for a long time. It's delivered a 30% return on the past year. But I'll just say that I still like treasuries for the deflation hedge as much as I like gold for the inflation hedge. But I'll just say that both are insurance policies against things going wrong. That's what I would say. And the one characteristic about bonds, or I would say treasuries, is that unlike other bonds, there is no default risk. We can talk about duration risk, and we can talk about rate risk. We can talk about inflation risk. That much is true. But you don't have capital risk. The one thing I do value about treasuries, irrespective of the yield, is that there is no other security where you know you're getting paid at the end of the maturity. So that's something you have to keep in the back of your mind. There's no default risk, and you know you're getting paid at the end of the day.
Mm-hmm. And the only thing I would say to that, and I do agree that sovereign debt is still a safe asset, but the real question is you're going to get repaid, but what's the value of the currency that you're getting repaid in, especially if it's a long-dated instrument. And I can see the argument for possibly bonds appreciating, but here we are very close to the zero bound, and I'm not sure what the upside in bonds would be if, once the 30-year gets to close to zero, and why would you have a big allocation to that? So that would be my reservation on the same allocation to bonds that we have seen historically.
I would tend to agree with you, John, and just add that, look, bond yields just hit record lows. The equity market has gone back to record highs. You look at relative value, and gold still is not at the high it was at 9 years ago. So there's lots of catching up. And so I would say that whereas maybe 6 months ago my harder conviction was on treasuries, which turned out to be a pretty good call, I have flipped and made gold my primary strategy right now.
Well, it sounds like gold's the ultimate value trade right now, which, coming from an old value shop, I like to hear that. So, well, David and John, thank you so much for taking the time out today. Hopefully everyone on this webcast found this insightful. I encourage you to, again, reach out to Rosenberg Research directly to see how you can work more directly and closely with David and his team, as well as reach out to our senior investment consultants at Spraw to learn more on how we can advise you on how to allocate to both the physical market as well as the equity market. So thank you all again for your time today, and wish you much luck and safety going into the summer. All the best.